Welcome to Market Pulse by Orestes Capital, your daily briefing on the key market moves, sector trends, and investment themes shaping the day. Today is Tuesday, June 23, 2026. We're Elena and Marcus.
Today, the technology sector really just bled out. Retail investors panicked. We saw circuit breakers tripping across Asia, and, highly favored U.S. semiconductor stocks went into a free fall.
Yeah, but yet the credit markets, which are really the ultimate lie detectors of the economy, they barely blinked.
It is a massive divergence, right?
It is. We are unpacking exactly where capital is hiding today, because our daily desk data paints a picture, not a systemic panic, but of a brutal, highly targeted rotation. So we have 4 critical themes mapped out from today's proprietary update, so you know exactly what the agenda is.
Right. First, we are tracking the tech contagion. We witnessed a massive derating in global semiconductors today, which was sparked in Seoul and violently spilled into U.S. markets.
And second, we are looking at rates and the SpaceX overhang. We will explore how safe haven buying drove front-end yields down, while a historic $25 billion corporate bond debut essentially pinned the long end of the curve.
Third is hard assets and geopolitics. Oil prices are sliding as the Strait of Hormuz reopens, which, occurred alongside a very strange, brutal collapse in silver.
Right. And finally, the credit market paradox. We need to dissect why high-yield bonds are completely ignoring the bloodbath we're seeing in technology stocks.
It's a lot to cover.
Moving to today's data, let's look at the macro picture and global rates. The Treasury curve and safe haven flows are sending distinct and, frankly, conflicting signals today. For anyone tracking the fixed income space, the movements we saw are painting a pretty complex picture of where capital is seeking shelter.
Yeah, exactly. The 2-year yield fell 3.8 basis points to 4.200%. The 10-year yield declined 1.4 basis points to 4.499%. But at the same time, the U.S. dollar index, the DXY, hit a 7-month high of 101.37.
Which presents a rather glaring paradox for you listening. We have front-end yields falling, which usually implies investors are expecting looser monetary policy or are rushing into safe havens.
Right.
But simultaneously, the dollar is surging to a 7-month high, which implies the exact opposite. A strong currency usually follows expectations of tighter policy and higher interest rates. When we look at today's data deck, there is a stark global policy divergence playing out that seems to explain this broader structural strength in the dollar.
Correct. Futures are currently pricing in nearly 2 Fed rate hikes by early 2027. The U.S. economy continues to show underlying data that suggests inflation could remain, sticky, prompting the institutional consensus to prepare for tighter policy down the road.
Right. But when you look at the rest of the world, the picture is completely different.
Exactly. The European Central Bank's Christine Lagarde leans distinctly dovish. That divergence pushed the euro to dollar exchange rate to an August low today.
And it is not just Europe. In the UK, the Bank of England favors an extended hold, explicitly refusing to signal any upcoming hikes.
Right. And furthermore, Hungary's central bank just cut its base rate by 25 basis points to 6.00%.
So the U.S. Federal Reserve is increasingly isolated in its hawkish trajectory. That global contrast, the Fed potentially hiking while Europe and emerging markets cut, is the structural advantage driving the dollar up.
But, that structural dollar strength doesn't explain the immediate drop in the 2-year Treasury yield today. That downward move in yield was driven by a combination of robust auction demand and very aggressive equity risk-off flows.
Oh, because capital was desperately escaping the tech route.
Yes, and it needed an immediate liquid place to park.
So if I am understanding this correctly, the market effectively says we will worry about the Federal Reserve's trajectory in 2027 later. Right now, we just need to protect our capital from the semiconductor collapse.
Correct.
That sudden wave of emergency buying temporarily supersedes the long-term macroeconomic pricing. It is a matter of sequencing and priority.
Precisely. Short-term survival always trumps long-term macro forecasting for institutional capital. When dealers need a safe haven today, the 2-year Treasury is the ultimate resting place.
But let's break down the longer end of the curve from first principles. We saw shorter-term yields falling on haven demand, but the 30-year Treasury seriously lagged today. It only fell 0.4 basis points to 4.948%.
Right, it barely moved.
I am looking at this supply overhang from SpaceX in our latest run. If SpaceX is issuing $25 billion in corporate debt, does that mean the dealer banks underwriting it actually have to dump long-dated treasuries just to make room on their own balance sheets?
You have hit on the exact mechanic there. It comes down to the basic plumbing of the bond market. For you listening, when a massive corporation like SpaceX issues a historic amount of investment-grade debt, and $25 billion is an enormous absorption event, the dealer banks underwriting that deal have to take that debt onto their books before they can distribute it to end investors. So to hedge their interest rate risk and clear capital, these dealers essentially short long-dated treasuries.
So you have this mechanical wave of treasury selling by the banks, not because they are bearish on U.S. debt, but just to prepare the pipeline for the SpaceX bonds.
Correct. That temporary, highly concentrated supply suppresses treasury bond prices and elevates their yields, specifically on the long end of the curve where the duration risk matches the corporate issuance.
Got it.
It acts as a massive anchor against the broader safe haven rally we saw on the short end today. So understanding this plumbing explains why a safe haven panic doesn't always push all bond yields down uniformly. Corporate issuance can hijack the yield curve.
On that point, let's transition to sector and equity flows, because the capital fleeing into those short-term treasuries had to come from somewhere. The semiconductor space was the absolute epicenter of today's price action.
Oh, the damage across the sector was severe. The NASDAQ 100 shed 3.3%, and the Philadelphia Semiconductor Index, known as the SOX, cratered 7.9%.
An almost 8% drop in a major sector index on a random Tuesday is a historically bizarre scale of movement.
It really is, and this whole avalanche actually started with a single headline out of Seoul. A local Korean media report indicated that SK Hynix is slowing its HBM4 AI memory expansion.
Now, for context, HBM4 is the high bandwidth memory crucial for powering advanced artificial intelligence processors.
Right, and instead of expanding that cutting-edge, high-margin technology, SK Hynix is reportedly pivoting their focus back toward traditional commodity DRAM.
So for anyone tracking the AI infrastructure build-out, that pivot implies a potential cooling in structural demand.
Exactly. That single headline triggered a 10% collapse in the KOSPI index, pronounced KOSPI. It activated circuit breakers in Seoul and created immediate violent contagion.
And that contagion spread instantly to U.S. movers. Micron, ticker MU, plunged 13.2% today ahead of its earnings release tomorrow.
The market is aggressively front-running the possibility that Micron will confirm the SK Hynix narrative during their earnings call. If Micron signals a slowdown in high-bandwidth memory demand, the entire thesis for the AI supercycle takes a major hit.
And other notable casualties swept up in the selling today included NVIDIA, AMD, and Marvell.
Yet here is where our daily desk data provides crucial context. When you look beneath the surface of those headline index drops, this was not a systemic panic.
It was a highly orderly growth to defensive rotation.
Exactly. If this were a true systemic liquidation, we would see indiscriminate selling across the board as investors dashed for cash. Every sector would be deep in the red.
But they weren't.
No. Instead, we saw a very targeted rotation. Capital exited high-multiple technology stocks and flowed directly into defensive sectors. Consumer staples, the XLP, gained 1.9%, and healthcare, the XLV, gained 1.4%.
Yeah, we saw specific gains in insurers like Allstate, ticker IL, and Erie Indemnity, ticker ERI, and consumer staples like Hershey, ticker HSY, and Conagra, ticker CAG. Even more telling, IBM gained 5.0% today. Investors are actively rewarding enterprise AI spending that is perceived as durable and cash flow positive, while violently punishing the highly speculative semiconductor hardware names.
This rotation highlights a critical shift in investor psychology. The market is no longer willing to pay infinite premiums for AI infrastructure promises. They are demanding immediate earnings visibility, dividend support, and lower volatility. Capital is simply seeking the safety of predictable cash flows.
Which brings up the sheer scale of the semiconductor moves today. Think about the current retail options market and ETF landscape like a tightly wound spring. When you have heavy retail participation in 3 times levered semiconductor ETFs, it actively amplifies the underlying volatility.
Oh, massively.
When the base index drops even a little bit on a negative headline, the mechanical daily rebalancing of those leveraged funds forces them to sell into the weakness. They are mechanically forced to sell low.
Because they have to sell to maintain their leverage ratios.
Correct. Which compresses the spring further until it violently snaps. Our desk stat illustrates this perfectly. The SOX index has moved plus or minus 5% on 8 of the 16 trading sessions in June.
That is the definition of structural fragility. The market structure itself, driven by algorithmic hedging and leveraged retail products, turns what should be a standard 2% fundamental correction into an 8% technical avalanche.
Right, so the long-term fundamentals of AI demand may remain intact, but the mechanical structure of the trade right now is clearly broken. It is a high-wire act with no safety net.
Understood. Let's examine commodities and hard assets, because the pricing there directly impacts the broader inflation picture and consumer health, tying back into that global rate divergence we discussed.
Okay, so looking at energy, WTI crude slipped 1.35% to $73 even per barrel, and Brent crude fell 1.57% to $76.92 per barrel.
The core driver here is the resumption of tanker traffic through the Strait of Hormuz following an interim U.S.-Iran deal.
For you listening, this geopolitical development acts as a massive macroeconomic relief valve. When oil prices are elevated due to geopolitical blockades, it functions as a direct gasoline tax on the consumer.
Right. It destroys discretionary income because families still have to commute and buy groceries, leaving less money for everything else.
Exactly. By reopening the strait and allowing physical supply to flow, the market removes that inflationary headwind.
Which theoretically gives the consumer, and by extension the broader economy, more breathing room. It is a net positive for economic stability.
But conversely, the metals complex faced a much darker session. Silver collapsed 5.39% to $61.58 per ounce. Gold also slid 1.74% to $4,117.19 per ounce, as the sheer strength of the dollar completely overwhelmed any geopolitical haven bid.
I want to debate this silver drop for a moment, because an over 5% drop in a single session is a brutal move. Obviously, the surging U.S. dollar makes dollar-denominated commodities universally more expensive for foreign buyers, reducing global demand. But there is a massive discrepancy here. Silver cratered, but copper remained completely flat. If silver is dropping purely because of a strong dollar, why didn't copper drop alongside it?
That is the real mystery in today's proprietary updates, and it comes down to their specific industrial applications. Silver relies heavily on advanced electronics. It is a highly conductive metal, crucial for manufacturing complex semiconductors and AI hardware components.
So it ties back to tech.
Exactly. When the SK Hynix headline hit, and the entire AI supply chain narrative fractured, the anticipated industrial demand for silver evaporated instantly. The market had priced silver for an aggressive AI manufacturing supercycle. When doubt hit that specific supply chain, silver was punished.
So the market effectively traded silver more like a semiconductor stock today than a traditional precious metal.
Exactly. But copper is entirely different. Copper is often viewed as the ultimate barometer for global manufacturing and physical grid expansion. It goes into homes, power lines, and traditional infrastructure.
Right, so the fact that copper refused to rally with the defensive rotation, yet also refused to collapse with silver, tells us something important. Physical grid expansion demand is currently offsetting the paper market panic we saw in high tech.
Copper is looking past the AI hype cycle and focusing on base-level global industrial growth, which remains surprisingly steady despite the volatility in technology.
Indeed. When we synthesize these moves across asset classes, a very specific market regime comes into focus for you. We are tracking a historic tech sell-off, a safe haven rally in short-term treasuries, sliding oil prices, removing the gasoline tax on consumers, and surging defensive equities, all occurring simultaneously.
It begs the question of whether we are looking at the start of a deep systemic recession or just a localized correction.
To finalize this synthesis, we must look at today's proprietary updates on the credit market. Credit is the fundamental bedrock of the financial system. Today, CDX investment-grade spreads sit contained at 50.89 basis points, and high yield is at 306.28 basis points.
And furthermore, high-yield ETFs like HYG and JNK were essentially flat on the day.
When we talk about high-yield spreads sitting contained, we need to clarify what that means in a real-world context. For you listening, when we say double B and triple C spreads are blowing out, we just mean that the interest rates the riskiest companies have to pay to borrow money suddenly skyrocket because investors are terrified of bankruptcies.
Right. If this were a true macroeconomic panic, we would expect to see immediate distress in those double B and triple C tranches of corporate debt.
Because the weakened companies always lose access to funding first during a systemic crisis. Credit markets are the ultimate lie detector for the economy. Equity traders tend to trade on sentiment and momentum, whereas bond traders trade on strict math and default risk.
If today's semiconductor collapse signaled a true fundamental growth scare or an impending recession, we would see immediate panic in those debt markets.
But they are completely ignoring the equity bloodbath. The riskiest corporate debt isn't flinching.
Correct. Because high-yield credit is completely stable, today's price action represents a highly localized multiple compression event. What that means is it is a valuation reset occurring exclusively within crowded, high-beta AI technology.
High beta simply refers to stocks that are far more volatile than the broader market, right?
Right, the market is aggressively correcting the astronomical price-to-earnings ratios of a few specific sectors, rather than signaling a systemic economic failure. The underlying corporate economy, according to the credit markets, remains highly stable.
That leaves us with a massive forward-looking puzzle to consider. We watched a colossal amount of capital flee the semiconductor space today. If AI terminal values are indeed capped and capital begins to flow out of semiconductors permanently, where does that wall of liquidity go?
Yeah, does it structurally re-rate defensive dividend-paying equities to historical premiums, fundamentally altering the index weightings for the rest of 2026?
I mean, if everyone is suddenly hiding in consumer staples and insurance companies, those historically boring sectors might start commanding the massive tech-like multiples we just saw, correct?
It is a regime shift we will be tracking closely in our daily desk data. A quick recap of today's core takeaways. Semiconductor fragility was exposed by SK Hynix, triggering a classic, highly targeted rotation into defensive equities.
Right, and falling oil prices from the Strait of Hormuz reopening provided major consumer relief by lifting that inflationary gasoline tax.
And highly resilient credit markets signaled that the broader economic damage remains contained, serving as the ultimate lie detector against the equity panic. Thank you for listening to Market Pulse by Orestes Capital. We're Elena and Marcus. We'll be back tomorrow with the latest market color.